Silver has just pushed through a level that capped price action for several sessions, and with settlement only hours away, fresh data is revealing a critical stress point that many traders still seem to be overlooking. What's unfolding beneath the surface may decide whether this move turns into a historic breakout or evolves into something far more volatile. Before we examine the numbers and their real implications, make sure to subscribe and hit the like button so you don't miss the market signals serious investors are watching right now. Silver has climbed above the 91 level, with first notice day now only 2 days away, a development that is clearly adding strain to short positions. Registered silver inventories currently total 87.2 million ounces. In just one day, 71 million ounces were rolled forward into later contracts, and expectations surrounding a potential March force majeure event, meaning a delivery disruption, have largely subsided. In Shanghai, silver futures closed at 104, while spot silver finished near 100, preserving an approximate $10 premium over Western markets, where both spot and futures continue trading around 90. At the same time, the gold-silver ratio has fallen below its 50-day moving average. Gold closed near 5,111.34, while the broader metals complex strengthened as well, with palladium advancing 4.5% and platinum rising 7.03%. With only 48 hours left before March settlement, market structure, the underlying price framework, has now broken through resistance that held firm for several days. For chart observers, strictly for educational purposes and not as a trading signal, resistance had been identified between 87.20 and 89. Price closed above that zone on the hourly chart, rallied toward 91, and has since retraced toward 90. On shorter timeframes, the structure remains intact, with the former resistance band now acting as support and the next technical objective near 92. This reflects a real-time observation of price, responding to previously identified levels rather than analysis applied after the fact. One metric drawing significant attention is the ongoing decline in physical silver backing futures contracts. Registered inventories now stand at 87.2 million ounces, following the largest single-day roll ever recorded at 71 million ounces. While force majeure concerns dominated discussion last month, current data suggests those risks have eased. Notably, prices moved higher during the roll instead of declining, implying that physical demand remains firm at current levels. Total open interest heading into settlement is near 115 million ounces, compared with roughly 87 million ounces available for delivery. Importantly, no substantial new metal is entering inventories. If this pattern continues, it strengthens the longer-term outlook for silver performance. Tracking how much physical metal supports the futures market remains a critical indicator of whether prices may trend higher later in 2026 as demand continues testing available supply. Historically, the process often begins with calendar splits. First March-May, followed by May-July, shifting from contango into backwardation, where near-term demand exceeds future pricing. When that transition takes place, outflows from COMEX inventories typically accelerate. Retail investors then begin recognizing that the move is not temporary and start allocating capital into ETFs, removing additional physical silver from circulation. On Tuesday, another 1 million ounces were withdrawn from registered COMEX stocks, leaving approximately 87 million ounces available for settlement. Ownership within COMEX vaults is unevenly distributed among participants, meaning it is inaccurate to assume all. Short positions are secure simply because aggregate open interest falls below registered inventory levels. Uneven allocation can still create delivery pressure for specific participants, even when headline figures appear manageable. Shanghai continues trading at a premium, with spot silver closing near 100, compared with Western pricing near 90. That persistent $10 gap between Asian physical demand and Western paper pricing has widened rather than narrowed, suggesting a structural pricing dislocation rather than temporary arbitrage conditions. Shanghai Futures Exchange inventories increased by 5.95 tons, yet regulatory enforcement activity has intensified. The exchange recently suspended additional trading groups for violations of Article 16 rules, bringing February's total suspensions to 25 groups. Officially, accounts exceeded daily opening limits. In practical terms, aggressive positioning prompted regulatory intervention. Such measures are rare and typically occur only when risk levels rise meaningfully. Because the Shanghai Futures Exchange serves as a major global physical pricing hub for silver, stress within that market influences worldwide flows. Strong enforcement activity often reflects volatility risk, concentrated positioning, liquidity imbalance, or potential delivery stress. These suspension notices are publicly available through exchange disclosures. The gold-silver ratio has now declined to roughly 57 after breaking below its 50-day moving average. Compression from levels above 60 toward 50 has historically indicated strengthening relative demand for silver. Silver recently reached 91.14, well above its 50-day moving average near 81. Since May 30th, that moving average has continued rising, reinforcing the appearance of an established uptrend rather than a temporary corrective bounce. At the same time, supply risks are emerging in Mexico, the world's largest silver producer. Silver has recently been classified as a critical mineral due to its importance in artificial intelligence and defense technologies. Roughly half of U.S. silver imports originate from Mexico, and U.S. modeling scenarios suggest disruptions there could affect economic output and raise national security concerns. Recent security incidents highlight growing operational challenges. Days ago, 10 mining workers were abducted, and 3 were later found dead. These events have complicated recruitment efforts and increased operational security costs. Even before this incident, cartel-related violence had been escalating, contributing to transportation disruptions and rising costs throughout the silver supply chain. While it is too early to describe the situation as catastrophic, risks are clearly increasing. These developments are occurring within a market that has operated in deficit for 5 consecutive years, while COMEX inventories continue declining. Global demand for silver remains strong as the largest supplier faces mounting operational pressures. Coordination between U.S. and Mexican authorities is reportedly aimed at restoring stability in northern regions affected by cartel activity, with early indications suggesting efforts to reinforce security conditions. Analysis of on-the-ground dynamics points to increasing pressure to protect economically critical sectors, such as mining. From a psychological standpoint, market stress often shifts participants toward rapid, emotional decision-making rather than careful analysis, a concept explored by Daniel Kahneman in the book Thinking, Fast and Slow. With settlement approaching, a persistent Shanghai premium, multiple account suspensions, and supply uncertainty, short sellers may face heightened psychological pressure. When covering becomes reactive instead of strategic, markets can generate sharp and sudden price movements. Similarly, research on crowd behavior in markets demonstrates how collective sentiment can shift quickly once participants recognize positioning imbalances. The suspension of 25 trading groups within a single month suggests positioning had become sufficiently concentrated to require intervention, reinforcing that underlying risks were tangible rather than theoretical. However, the opposing perspective must also be acknowledged. The successful roll of 71 million ounces shows that normal settlement mechanics remain functional, and force majeure fears have not materialized. March settlement could conclude without major disruption if remaining positions continue rolling forward or opt for cash settlement. The Shanghai premium may narrow if Chinese demand weakens or Western supply increases, and Mexico's security situation could stabilize through coordinated policy action. This discussion is intended for financial market education, not investment advice. The key facts remain: roughly 48 hours until settlement, 87 million ounces registered against 115 million ounces of open interest, a persistent $10 Shanghai premium, active exchange enforcement against aggressive positioning, rising supply risks in Mexico, a gold-silver ratio, breaking support, and a technical structure that remains intact. Force majeure concerns have eased following the large roll, yet underlying pressures appear delayed rather than eliminated. The next 48 hours will be critical. Monitor CME data, review Shanghai Futures Exchange enforcement notices, and watch whether the Shanghai premium persists. Those who follow these indicators closely can understand developing market conditions in real time rather than interpreting them only after outcomes become obvious. Invest with discipline and logic, not hype. If you found this breakdown helpful, make sure to subscribe and give the video a like so you don't miss the next market update. I'd also like to hear your perspective. Do you believe silver's current pressure is building toward a major breakout, or simply short-term volatility? Share your thoughts in the comments below, and let's discuss.